Hi there, thanks for tuning in. Today we're going to talk about intrinsic value and what it actually means. The concept of intrinsic value is something I'm going to start using in a lot of my videos from now to the future. So I want to talk about exactly what this means before I hop into explaining some financial models, for example, in future videos. And as we should, let's start with a definition here. By definition, intrinsic value would be the true value of a given asset, usually a stock or an investment. However, this really is just a value that we're calculating by trying to use some quantitative and sometimes qualitative measures. That is to say, I'm sure things have a true value, but we can only give our best calculation based on the information available. And this true value is theoretically going to change when more information becomes available. That is to say, if we think a company is growing at 5% every year for the next 5 years, and all of a sudden there's a very severe recession, this company's growth prospects are going to change, and thus their intrinsic value or their true value is also going to change because all of a sudden the economy has changed and they probably can't be expected to grow as much. Or the flip side can also happen with commodities, for example. We can see the price of a given commodity go through a boom, and the companies that produce products made out of that commodity can actually benefit from it. We can see that with the price of oil, for example. Oil went through a pretty long slump throughout the 2010s. However, recently the price of oil has picked back up, and companies that produce oil, at least those that had been doing decently before, are doing amazingly right now. And the thing is, I don't know if anyone who was forecasting the price of oil in 2018 could have seen this coming, because at the end of the day, there are multiple things that can move the price of oil that frankly no one can really predict with complete accuracy. So it is important to update your calculations every so often as new information becomes available. And the other thing that I think is important and that you'll hear be recommended to potential investors is that you should probably calculate the intrinsic value first and then think about looking at the current price of an asset. Let's pretend I'm buying an apartment that I want to rent. So I want to generate some yearly income out of it. Well, let's also pretend I don't know the price of it. Well, I may want to just calculate the intrinsic value beforehand by maybe calculating how much I'm going to make every year, plus rent increases and discount it to a certain rate. And based on that, I will get a given value, and then I can look at the asking price for the apartment and compare it to the value I got. Based on this example, what is intrinsic value actually telling us? Well, it's telling us how under or overvalued something is going to be. If the true value of a stock is going to be $100 and it's currently trading at $150, it's incredibly overvalued. On the flip side, if the true value is $100 and it's currently trading at $50, it's undervalued and it's a fantastic opportunity, potentially. But I've been talking a lot about the true value of things, but not exactly how to calculate it. So how do you actually calculate it? Well, most professionals will use quantitative models, such as the discounted cash flow model, for example, which grabs the expected cash flows for future years and then discounts them at a given rate of return. And this is a formula that you can straight up plug your calculations into, and then it'll straight up give you an expected value. There's variations on this as well. For example, there's the dividend discount model, which will give you an expected value based on the dividends that something has given you and the expected rate of growth of these dividends. You can even put dividends as the cash flow in a discounted cash flow model and get that as the result. But besides these two models, there's also asset-based valuation, which is simply grabbing all of the assets of a firm, calculating the value of those, and then discounting the value of all the liabilities of a firm. It can be nice for understanding their balance sheet, however, it may also be missing things such as an expected growth rate. So usually the intrinsic value you're going to get from this is probably a lot lower than reality. It also works better with firms that have a lot of assets. Tech firms usually don't have a lot of assets because a lot of their assets are digital and don't cost that much overhead, and maybe a lot of the value there comes from intellectual property rather than necessarily physical goods. And this is just something important to note. Not all of the quantitative models are gonna apply to every single firm, and your intrinsic value may look incredibly different because the nature of an investment may be different from another one. So there's no one model that fits all. Even some of the preferred models, such as discounted cash flow, simply won't work for companies that have negative cash flows. These are all quantitative methods, but at the same time, I want to stress that quantitative measures do matter. For example, a company's moat, that is to say, how difficult is it for new competitors to penetrate into the market that this current company is addressing? Companies with a wide moat may justify higher valuations in some way because it's much less likely that a new competitor is going to just come in and disrupt its business. Or as mentioned before, there's intellectual property. this matters. This can be sold for a lot in the case of the company being acquired, for example. So that means that even though it doesn't show up in the company's balance sheet or cash flow statements, well, it does matter. This is to say, arriving at the true value of a company takes a lot of research, and you have to consider a lot of different factors. There's no one-size-fits-all model, and that's why due diligence is going to be incredibly important. You just can't go in blind expecting to know the actual value. However, if you're willing to put in the work to sort of approximate at the intrinsic value of a company, well, you can find incredible opportunities, especially for companies that are undervalued, or avoid companies that are seriously overvalued. This really does matter, especially because it helps you gain an edge over your expected returns over a long period of time. But I do want to address some of the negatives of intrinsic value, and that is in most of these models, there is a certain degree of input sensitivity. If you change the growth rate of a company just by a little bit, or if you change maybe the expected rate of return or the risk-free rate or other variables like that, you can get a wildly different valuation. If I'm valuing a stock and all of a sudden I change the rate of return that I expect from 10% to 15%, well, for a higher rate of return, you would have to pay less for a stock, and that means that the value of it will go significantly down, which is another reason why I think it's actually important to do the intrinsic value calculation first, because if you know the price of an asset beforehand, you may be tempted to adjust your calculation to better fit the current price. It's called anchoring, and it's a cognitive bias that we all have, where if we know a certain number beforehand, we'll sort of try and adjust our calculations to fit the narrative of that number, whether or not it's correct. So just beware of anchoring, and beware of exactness. Don't worry too much about getting the exact intrinsic value, because the thing is, you're not going to know all available information at every single point in time. It's more important to get a decent idea through a quantitative model like the ones I mentioned before, and then maybe do some further research into those qualitative things. You're getting a ballpark estimation here, and spending a lot of time into making it perfect is probably not the best use of your resources. And to cover for the pitfalls of exactness, let's talk about margin of safety. Margin of safety is a concept introduced by Graham and Dodd, which basically says that you should pay a certain price below the intrinsic value of something to account for your own biases and for any errors in the calculation. And this price or percentage below the intrinsic value that you're paying can also actually change. Say we're looking at a company like Apple, for example, which actually has pretty decently predictable cash flows. You're never gonna know exactly what they're going to be, but for the most part, they're pretty consistent. So let's say for Apple, we get an intrinsic value of $100. Well, maybe we just want a margin of safety of 5%. That is, we're willing to pay $95 or below for Apple, because we pretty much know that our calculation isn't going to be incredibly far off. Apple is a company that doesn't see that much volatility. However, if there's a company that we get an intrinsic value of $100 for, but it is in an incredibly volatile market, or any economic change can affect it severely, well, maybe we would want a margin of safety a lot bigger, maybe 30 or 40%. So if the intrinsic value is $100 and I want a margin of safety of 40%, then I should be paying $60 or below for this particular stock. Margin of safety is an incredibly important concept in value investing, and focusing more on the margin of safety rather than being truly exact with your calculations can help you a lot. That also means that any losses you might see from investing in a company that seemed undervalued but maybe hasn't realized that value will be very limited. The intrinsic value of a company is $100, but I pay $60 for it, and at the end of the day, maybe they're not doing that great for a while. Well, maybe their value will go from $60 to $50, but unless anything huge changes, it probably won't go from 60 to 0. It'll probably just stay at a mild loss for a little bit. And this is to say that even though you're getting the intrinsic value of things, don't succumb to arrogance. Don't think that because you have the exact value of something, it means you're going to be right all the time. In fact, just because you have the intrinsic value of something doesn't mean it's going to go to that intrinsic value immediately. Sometimes these things are going to take years to play out. Say the intrinsic value of a company is $100, it's currently trading at $50, but the thing is, a lot of these future cash flows just haven't kicked in yet. Maybe there's certain projects that they're realizing that will give a lot of value in the future, but they won't in these coming years. Well, in that case, you shouldn't be surprised if the company stays at that $50 level for a very long time and doesn't go to $100 until those projects kick in and start bringing consistent cash flows. However, I find that knowing the intrinsic value and sticking to a margin of safety probably helps you sleep better at night as an investor, because the thing is, you can see those negative numbers, all of a sudden the stock goes down 10% and not care, because you know it is factually worth more than that. I think that's all I want to say about intrinsic value today, but if you have any questions or want me to further elaborate on anything, feel free to ask in the comments. Before I go, if you're interested in investing, I could highly recommend Webull as your broker. I personally use Webull. It's a commission-free broker that has a very nice interface and is pretty fast, so I'm pretty happy with it. And if you sign up using the link down in the description, they usually give free stock or free promotions. So that's literally risk-free return for you. That is it for today. I thank you so much for watching. If you want to see more content like this, remember to subscribe. And with that said, I hope you have an excellent rest of your day.